Good morning. My name is Richard Kersley. I'm the Executive Director of Securities Research at Credit Suisse in London and also a member of the Credit Suisse Research Institute. I'm delighted to welcome you to the launch of the 15th edition of the Credit Suisse Global Investment Returns Yearbook. And to do so, we're of course joined by the authors Paul Marsh and Mike Staunton of London Business School, and also Professor Elroy Dimson from the Judge Business School at Cambridge University. Indeed, our work with Paul, Elroy and Mike is something, again, we're exceptionally proud of. It's a long-standing collaboration with ourselves at Credit Suisse. And the nature of the content that the yearbook delivers fits very much with the mission of the CSRI, the firm's in-house think tank, which is to provide thematic content for our clients based off proprietary insights and data. I mean, whether from leading external experts, as we have on the call today, or indeed our own leading researchers and analysts at Credit Suisse. I'm going to hand over to Paul in a second to run through the themes of this year's edition of the yearbook, and I think you'll find this year's specific focus on inflation topical, to say the least. But to complete a few formalities before I do so, I just want to stress you should have a press release related to the publication. Indeed, the slide deck will be running through, and a summary edition of the yearbook. We've also shared with you individual country summaries for participants on the call here from, again, the countries unique to yourselves. But should you have not received any of that material, please do reach out to us. And a final thing I'll just say is that should you have questions and so forth, we'll be handling those at the end, and I'll be moderating those accordingly. But anyway, with no further ado, I'll pass over to Paul to take us through the key findings of this year's edition. Paul, over to you, sir.
Thank you, Richard. Hello, everybody, and thank you very much for joining us. The Credit Suisse Global Investment Returns Yearbook documents and analyzes investment returns since 1900. And the purpose is not to give you a history lesson, but it's to use this long period of financial history to shed light on today's investment issues. As Machiavelli said, whoever wishes to foresee the future must consult the past. We're going to be covering three topics today. First of all, I'm going to explain to you the yearbook database and the basic contents of the yearbook. The yearbook is much more than we're going to be able to cover today. And I'll give a very brief, in one slide, historical summary of global investment returns. Second, we'll look at three issues which have dominated the past year: inflation, hiking cycles, and real interest rates. Most of you are far too young to remember periods of high inflation, bond bear markets, or years when stocks and bonds fell sharply together. The strength of the yearbook is its long-term memory. The yearbook has seen it all before. And the third topic we'll look at is investing in commodities. And when we get to that, I'll explain why we've chosen commodities this year as our special topic. At the heart of the yearbook is our long-run database. It covers 90 markets now, stocks, bonds, bills, inflation, currency, and GDP over a period of up to 123 years from 1900. The countries in blue are the 35 DMS markets. The database is called, immodestly, the DMS database, Dimson, Marsh, Staunton. And the 35 yearbook countries that we feature in some depth in the yearbook, there are 55 others which we feature in less depth, are shown in blue here. Of those, 23 start in 1900. 2 have discontinuous histories, Russia and China, where there was a long interlude of the communist period when markets were closed, but nevertheless, they start in 1900 and they resume when the markets reopened. There are 12 more markets with long histories, but that don't start in 1900. They typically have 50 or 70 years of data. They're the ones that have got the turquoise glow around them. And there are 55 other markets, the ones shown in light blue, where we have equity coverage only. So they enter our equity indices, but we don't yet have bond data for those countries. The countries that are not covered are the ones shown in brown, and you can see they're predominantly in Africa, but a few dotted around in Asia and Central America. So 90 countries in total, and we also have 5 composite indices. Those composite indices cover the world excluding the United States, Europe, emerging markets, and developed markets. The yearbook itself, there is a picture of its front cover, in all of its 272 pages of glory, covers long-run returns since 1900, stocks, bonds, bills, inflation, currency, as well as risk premiums and factor premiums. And the first 7 chapters cover all of that in a great deal of depth. Each year we have a special focus chapter. This year the special focus is commodities and inflation, but you can see the topics that we've covered in previous years. We'll have quite a bit to say today about diversification, and that was the special topic last year. You can see there's been many other special topics in recent years. And then finally, there's a very long chapter at the end of the yearbook, which provides charts, tables, and text on the individual 35 countries that we cover in depth and on the 5 composite indices. We're going to be covering only a very small part of the yearbook today, so we hope you'll get a hard copy and read more of it. And our hope is that as journalists, you'll keep it nearby and you'll reach for it whenever you have a story that might benefit from some historical perspective. I promised you just one slide on historical returns, and this is it. This shows the 21 yearbook countries for which we have continuous history since 1900. So it's 123 years of history here. And we also are showing here the 5 composite indices, which also all start in 1900. And these blue bars are the real equity returns. Everything in this chart is shown in common currency, here taken as US dollars, but the rankings of countries would be the same whatever currency we chose. And you can see that equity returns have been high, between sort of 2 and 6% typically in all of these countries. So stocks have beaten inflation everywhere. Here are the bond returns, and you can see that there are 6 countries and 1 composite index where bond returns were actually negative. But the thing to notice here is that stocks beat bonds in every single country. And finally, here are the bill returns, treasury bills or cash. And again, these are lower than bond returns everywhere, with a small exception of Portugal. And this indicates that over the very long run, 123 years since 1900, the law of risk and return has held. The riskiest asset category, which is equities, has generated the highest returns. The second highest risk category, the bonds, these are government bonds. These are long government bonds, 10, 20-year bonds, and they have given intermediate returns, and the lowest returns have come from the lowest risk asset, which is bills. So the law of risk and return has held over the long run. One other thing you'll note here is that although the USA is not quite the best performing equity market in the world, it was last year, but the excitement of 2022 has led Australia to just nip ahead of the United States. But the United States has generated a very high equity return of 6.4%. Remember, these are real returns after taking account of inflation, after deducting inflation. The USA has, over the last 123 years, been the world's most successful economy. It's been the world's superpower, the world's super economy. And it's hardly surprising that US equity returns are very high. When we started the yearbook back in 1999, all we knew about global investment returns was from the United States. And that's why we took a global focus, because we felt that it was almost self-evident that the US would have done very well, and that by looking at the US returns, these would not be typical of the rest of the world. And you can see from this chart that the rest of the world, the WXU bars, the world excluding the United States, gave a real return of 4.3%, still perfectly respectable, but considerably less than the United States itself. Some of the countries in this chart have been unlucky. Austria, down at the bottom there, Italy, Belgium, France, and Germany, all embroiled in two major world wars. Austria lost its empire, and so on. At the right-hand side, we have Australia, which is often known as the lucky country, along with a bunch of other New World countries and Denmark. These have been lucky countries. They've done extremely well historically. We shouldn't read too much or start projecting future returns from these past returns for individual countries. It's better to focus on the world, the experience of a global investor who invested worldwide over the last 123 years. And there you can see that the return on equities has been 5% in real terms on the world index. You can also see that relative to treasury bills, equities generated a risk premium of 4.6%. They did 4.6% per annum better than treasury bills. And you can also see that equities have beaten bonds by 3.3% per annum, the historical equity risk premium relative to bonds. So for the risk of equities, there has been a very handsome reward, a large historical premium of 4.6% per annum. In future, we expect a somewhat lower premium of around 3.5%. And if you're interested in the reasons for that, there's a lot of information in chapter 5 of the yearbook. Let me move on to inflation, hiking cycles, and real interest rates. These were all big drivers of investment returns in 2022. But equally, they're all topics on which the yearbook provides extensive long-run evidence. So looking at these topics will help to illustrate how the yearbook helps inform current issues. Looking at inflation over the long run, this is for the 21 DMS countries with continuous histories. You can see that periodically inflation flares up. And typically it flares up in periods of war or energy crisis. And in last year, we had both of those. We had war and energy crisis. By the time we got to the end of 2020, we were at the lowest level of inflation averaged across the countries since 1934. By the time we got to the end of 2022, 2 years later, it was up 19-fold, from 0.4% to 8%. Inflation had flared up again. During 2022, the US hit a 41-year inflation high, the UK 42-year high, and Germany a 71-year high. There's signs by the end of 2022 that inflation had peaked, but historically, it has proved sticky. In a recent paper, Arnott and Shakania looked at inflation persistence in 14 developed economies since 1970. And they found that historically, once inflation hits 8%, it can take multiple years to revert to target. And they felt that the market is currently being over-optimistic about the speed with which we will get back to target levels of inflation. Is inflation good or bad for stocks and bonds? Well, we all know it's bad for bonds. What we've done here is we've looked at every country year in the database, and we've looked at inflation, bond, and equity returns in that same year. And these are the inflation boundaries that we looked at. We looked at the lowest 5% of inflation, the next 15 through to the top 5%. And this is the real bond returns that happened during those periods. So when inflation was exceedingly low, in periods of deflation, bonds did quite well. In periods of high inflation, bonds did absolutely dreadfully. And that's exactly what you would expect bonds to do. But if you look at real equity returns, you can see that in periods of deflation, they didn't do too badly, but you would have been better off in bonds. And in periods when inflation was high, equities did poorly. Equities are not an inflation hedge. When inflation is high, they do poorly. They tend to do poorly. But long run, they have beaten inflation. So a lot of people claim they're an inflation hedge, but they're confused. In the long run, stocks beat inflation, but they do that because of the equity risk premium. They are not an inflation hedge. They have a negative correlation with inflation. A lot of investors are worrying about stagnation. They can see that even if inflation is coming down, it's going to still be elevated for a while, and economic growth looks pretty miserable. So we've looked at what happens in periods of stagflation, periods of higher inflation coupled with lower growth. And to do that, we've taken again all of the country years in the database, and we've divided those up into those with the third with the lowest GDP growth, the middling GDP growth, and the highest GDP growth. And within each of those GDP growth bands, we've looked at higher inflation through to lower inflation. And you can see in the set of bars for the lower GDP growth that as inflation gets lower, the returns on equities get higher and the returns on bonds get higher. So that's the same story as in the previous chart, but you can see that in the stagflation, there's 9 categories here. In the stagflation, in the lowest category, higher inflation, lower GDP growth, there are very poor returns on both equities and bonds. Here's the middling growth. Again, you've got the same pattern. That is, as inflation gets lower, the returns on both stocks and bonds get higher, and the same pattern in the higher GDP growth band. But here you can see that in the precise opposite of stagflation, which we've called stable growth, that the equity returns and the bond returns are very high. So stagflation, very bad news. Stable growth would be where we'd all like to be. And investors are right to fear lower growth coupled with higher inflation. To cure inflation, central banks indulge in hiking cycles. And we've seen a great deal of that globally, and especially from the Fed during 2022. What happens during hiking cycles? We've looked at every hiking cycle and easing cycle in the USA since 1914, which was shortly after the Fed was set up, and every hiking cycle and easing cycle in the UK since 1930. And we've looked at what happens to stocks, bonds, bills, and inflation after rate falls and after rate rises. And you can see that in terms of real equity returns, during easing cycles, the real returns on equities are very high in the US, but they're pretty low after rate rises. The same for bonds, the same for bills, and inflation is higher when after rate rises than after rate falls. In the UK, the same pattern. So hiking cycles are bad news for stocks and bonds, just as inflation itself is bad news. And you have to ask the question whether or not the falls we see from equities and bonds during periods of inflation are because of the inflation or because of the cure. And the answer is it's a bit of each. And it's also worth noting that the equity risk premium was nearly all earned during easing cycles. And in the UK, all of it was earned during easing cycles. So two things were bad news in 2022 for both stocks and bonds. The first was inflation. The second was the cure for inflation. The third was real interest rates. And this is the pattern of real interest rates as shown by Treasury. Sorry, not Treasury. These are inflation protected bonds in the United States. We call these TIPS. In the UK, we call them index-linked gilts. These are 10-year yields. And you can see that back in 2000, the average was close to 4%. The average is the dark black line here. And you can see that by the start of 2023, the average was 0.5. It's interesting to note that in the last year, that average has gone up from to 0.5 from minus 1.5. At the end of 2021, it was minus 1.5. There has been a 2% increase in the yields on 10-year linkers. And that's a very big increase. What does this mean? Well, if you think of bonds or equities as being a string of cash flows in the future, discounted at the real interest rate plus some premium for risk, if you suddenly reduce the discount rate, or you reduce it over a 22-year period from 2000, falling yields boost valuations. But as you boost valuations, so you lower expected returns. Think of it in terms of bonds. If the price of a bond rises, the yield falls. So it's exactly the opposite. And when the yield is lower, then the expected return from the bond is lower. And that's exactly what happened for the first 22 years of the 21st century. Real interest rates were falling, and that supported asset values, but it lowered the future expected returns. And what's happened in 2022 is we've had this sudden sharp increase, and so the and vice versa comes into play. And what we then have is rising yields hit valuations, but increase expected returns in the future. And that is the third thing that weighed on stocks and bonds last year, the increase in the yields or the increase in the real rate of interest. And that's why we had a painful 2022. These are the 10 largest markets in the world, plus the world index. You can see that on the world index, equities in real USD terms lost 22%, and bonds lost minus 27. This is after a fairly decent recovery in the final quarter of last year as well. Just look at those bond returns. They are something we haven't seen for a very long time. And in some cases, in the case of the United States, Great Britain, Switzerland, the developed world as a whole, is something we haven't seen in our entire database. These are the lowest returns ever recorded for bonds in 123 years. So last year was something special. So bonds and stocks were hit by inflation. They were hit by hiking cycles. They were hit by higher real interest rates. Stocks and bonds, in lots of people's minds, aren't meant to fall together. They're meant to be a hedge. Why do people believe that? Well, this is a chart that we showed last year in last year's yearbook. And this shows the stock bond correlation. And in the first half of the 20th century, 1900 to 1949, you can see that the average stock bond correlation was 0.45. In the second half of the 20th century, you can see that it was 0.34. But in the 21st century, up till 2021, it was negative at minus 0.23. So stocks and bonds were acting on average as a hedge for each other during, but what we warned last year was that the 21st century was an exception. This was a period of easy money, of low inflation, of low interest rates, and you should not therefore if the winds of change were blowing, as they were at the end of last year, necessarily expect negative stock-bond correlations in the future. After 2000, bonds were a hedge, but in 2022, as we've seen, that changed. Both stocks and bonds fell together. This is a chart of the drawdowns historically in US bonds and stocks since 1900. You can see that there are some very serious drawdowns in equities. The one that goes down to minus 80%, where investors lost 4/5 of their money in real terms, is of course the Wall Street crash. You can also see that bonds had some very deep drawdowns. The lighter shaded area here shows that there was a more than 50-year period when bonds were underwater in real terms in the United States. That's a much longer drawdown than equities have ever experienced. This is what happens if you go for a 60-40 equity bond blend. Because the correlation between stocks and bonds is well below 1, you can see that you get a great deal of very powerful diversification here. And that diversification allows for the drawdowns to be shorter and less severe, although there was a large 31% drawdown in 2022. That's the one that we've just been talking about. Those 60-40 drawdowns are shallower and shorter, and that shows the power of diversification. If the bond equity correlation is negative, that diversification works even better. But we should not rely on that for the future. We believe that that was something that is going to historically look like it belonged only to this period of cheap money in the early 21st century. I want to now look at some projected returns for the future. But in looking at those projected returns, we need to work out what the baseline is. And the baseline is the real interest rate. The real interest rate helps us to assess what future returns are going to be, because it's the baseline for all risky assets. The real return on equities in the future is the real interest rate plus the equity risk premium. That gives us the expected real equity return. So what's happened historically? This is another of these charts where we are sorting everything into country years, but here we're sorting them into by their real interest rate. So on the left of this chart, we have periods of low real interest rates, and on the right, we have high real interest rates. And then we look what happens over the next 5 years. And you can see that for equities, when real interest rates are low, equity returns are low over the next 5 years. And when real interest rates are high, the opposite is true. Equity returns are high. And exactly the same is true for bonds. And so in thinking about future returns and what we can expect, it is reasonable to use the real interest rate as the baseline for the expected return on risky assets. Let me briefly return to bonds, because bonds is the area where past returns, recent past returns, have been very different from what we can expect in the future. This is the first half of the 20th century. Real returns on bonds in the USA, UK, average European country, and average of all 21 countries for which we have continuous histories. And you can see that bond returns were pretty low in the first 50 years of the 20th century. In the next 32 years, until 1981, bond returns were negative. This was a period of higher inflation. And then we had this extraordinary period from 1982 to 2021 when bonds gave equity-like returns. And then we had 2022 when they didn't, when they really, really bombed out. And if you look at the average across all years, bond returns have been quite modest. The problem is people look back at that period, 82 to 2021, because it covers it covered until last year, most of their working lives. And they tended to project high bond returns into the future, rather than looking at bond yields, which would have given a much better indication of that. The problem when you have this sort of thing is that you tend to map off past experience rather than long-run experience. Long-run experience should have told us, and did tell us, that those equity-like returns were unsustainable. This is past returns by generation. And very crudely, we've classified the world since 1950 as with baby boomers, the world since 1970 as Generation X, and the world since 1990 as millennials. And these are the returns people, investors have got in the different generations, birth generations, depending when you were lucky enough to start investing. And you can see that the baby boomers have done extraordinarily well in equities. Generation X has done well in equities. Millennials have done absolutely fine in equities, but not quite as well as Generation X or the baby boomers. You can see that those very high real returns from bonds have given a 4% and a 4.2% return for Generation X and millennials, and even a 2.9% for baby boomers. And those returns are the ones that we were referring to in the previous slide as unsustainable. And interestingly, the 60-40 blend has given fairly similar returns across those three generations. What can Generation Z, the next generation, expect? These are just illustrative figures at the start of 2023, but we think that 4% from equities is reasonable. We're just taking current linkers, inflation-protected bonds, as our baseline here to get an idea of what the real rate of interest will be over this next generation. And we're adding on to that a 3.5% equity risk premium. So Generation Z can expect almost the same bond returns as millennials, but nothing like the baby boomers got. But the bond return is likely to be much lower in the future than it was for those previous generations. And the 60-40 blend is also likely to be much lower in the future. We've exited in 2022 from the recent ultra-low return environment. When you're in a very low return world, as we were at the start of 2022, when the average yield on those 10-year inflation-protected bonds was minus 1.5%, when you're in a low return world like that, at least two things can happen. One is that you just get a series of low returns in the future. The other is that you get a very, very bad year of very low returns. And that bad year of very low returns actually is something you take on the head, but then the expected returns in the future are higher, as we showed in the earlier slide. So since we showed a similar chart last year, the expected returns for Generation Z have gone up. They've gone up because we had a really bad year in 2022. So a Generation Zer who didn't start investing last year, but starts now, faces higher returns prospectively in the future, but not as good a return as their previous generations have obtained. Now we're moving on to investing in commodities. And why have we chosen commodities to look at this year? Well, inflation's been a major issue, and commodities, rises in energy prices, food prices, and so on, have contributed to that inflation. And so we were interested to look and see whether investing in commodities provides a reasonable return and also a hedge against inflation. We've looked at 29 physical commodities for which we could get prices from 1900 to 2022. And I'm just going to show a representative sample of those in this chart. The chart shows the cumulative real return from an initial investment of $1. So we're basically standardizing all the prices to a starting value of $1. And then we're looking at their real progression over time, over 123 years. So here are the first four. And I've chosen one commodity from each of the standard commodity groupings. So copper is an industrial metal, corn is a grain, sugar is a soft commodity, cotton is an other agricultural commodity. And you can see that all of these ended up with less money than you started with in real terms. In other words, none of these commodities kept pace with inflation over 123 years. Now, here are three commodities that did keep pace with inflation. And these are gold, oil, and cattle. So cattle are from livestock category, oil is from energy futures, energy commodities, and gold is precious metal, of course. And you can see that gold is the best of the ones I'm showing here. And $1 became $2.5 in real terms after 123 years. That's a real return of 0.8% per annum. Now, gold is a very emotive subject. Every time we talk about gold in the yearbook, we get abusive emails from gold bugs who believe that gold can only go up. But you can see that gold has gone up. It's given a positive real return. It's beaten US Treasury bills, it's beaten US inflation. But if I tell you that that 2.5 compares with 8 for US bonds and more than 2,000 for US equities, you can see that gold over the long run has been an unexciting investment. It has other merits, as we'll see. It's an inflation hedge. It's also a precautionary investment. If you live in parts of the world which are in turmoil, holding some gold, it's a portable asset, it's a universal asset, it's a precautionary asset. So gold has various merits, but as a as a competitor to equities, it is not. So we have low returns from individual commodities. Of the 29 we looked at, 21 gave negative annualized returns. But look what happens when you form an equally weighted portfolio of these commodities. You get much, much higher terminal values of 12. The average return on the individual commodities, the average annualized return, was minus 0.5% per year. The average return when you put the 29 into an equally weighted index of commodities was 2% per year. The reason for that is the commodities are highly uncorrelated. The average correlation between them is just 0.2. So the average volatility for individual commodities was 28% per annum, but it was just 12.5% for the equally weighted index. And the power of diversification is such that that manages to transform itself into an annualized return, which is much higher than the average annualized return on the individual commodities. That's what diversification does for you. In the literature, this is talked about as turning water into wine. Less colloquially, people refer to this as the diversification premium. This is the impact of diversifying. So whatever you do, invest in individual commodities, always invest in equally weighted indexes. And I'm going to come on to futures next. These are spot or physical commodities. The same is true for futures. With futures, everything that I will show you is the returns from an equally weighted index of futures. You do not make money from investing in just individual futures, unless you're very skilled at picking the right one at the right time. Futures are different. Most investors avoid physical commodities like the plague. The reason for that is they're expensive to store. Think about frozen orange juice, think about live cattle, think about combustible petroleum products. They're difficult and costly to store. You have to insure them. transport them, there's a cost of carry, there's a cost of management time. So the returns I showed in the previous slide are all pre-cost returns, and they would be significantly lower once you factored in these costs. Futures are much more satisfactory. Futures contract will have a delivery date, but you avoid delivery by just before delivery rolling it over into the next delivery date contract. So you have a rolling investment in futures. When you buy a futures contract, no cash changes hands, but you do have to post margin, and so you have a highly leveraged position. We focus, as does everybody in the literature, and if you buy an ETF of commodities, you'll also find the same is true, on fully collateralized futures. So if the contract value is $1,000, you post $1,000 in treasury bills, you earn the interest on treasury bills meanwhile, and that gets rid of the leverage. So you're no longer holding a leverage position. And then we can make reasonable comparisons between commodities and other assets like stocks and bonds. So everything I'm going to be talking about is a portfolio, and everything I'm going to be talking about is fully collateralized futures. But I'm not going to keep saying that because it's too much of a mouthful each time. The futures prices also reflect expected trends and seasonality. People operating in the futures markets are wise enough to know that if prices of a particular commodity are always lower in winter, you factor that in to the price you pay for the futures contract. So market expected price movements are not a source of return in the same way that they are for physical commodities. So how do you make money? Well, it's just like in equities. Either you are smarter, that is, you're an active investor and you trade on your skills at selecting securities, or else you're a passive investor and you expect to earn a risk premium. Why would you earn a risk premium from investing in commodity futures? Well, the common argument for this is called normal backwardation. What that means is producers of commodities want to hedge, so they're prepared to pay an insurance premium, and they do this by selling futures. The buyers of the futures are providing a service to the producers, and in return for that, they receive a risk premium. Whether this is a correct view, it's obviously an oversimplification, a gross oversimplification, is not really the point here. We're going to treat whether or not there is a risk premium as an empirical question and see whether there really is. AQR Capital Management and Commodity Systems, who provided AQR with some of the data, have generously provided us with a data set from 1877 right up to the present. And this chart shows the futures excess return. Now, by excess return, I mean the return on futures adjusted for the return on treasury bills. So this is the futures return minus the treasury bill return. In equity parlance, this would be the risk premium, and it's the same in the futures world. When we look at equities minus the treasury bill rate, we're looking at the equity risk premium. So what we're looking at here is the futures risk premium, the excess return on futures. This is the excess return on spot commodities for exactly the same set of commodities, thanks to the AQR dataset allowing us to do this. And you can see that although there's a very handsome risk premium on futures, there is not a handsome risk premium on spot commodities. It's the futures where the risk premium clocks in. If you prefer to look at these same figures in real terms, they're a little higher because we're deducting inflation rather than deducting the treasury bill rate, and the treasury bill rate exceeds the inflation rate. Now let's compare stocks and bonds with futures. And here we're switching data sets. We're switching data sets to a data set that came out of a paper by three guys called Bawaj, Janardanan, and Rowenhorst. If I have to refer to them again, I'm going to call them BJR. And they are associated with Summerhaven Investment Management, who have updated the data set from their 2019 paper. And so we can trace all the way through from 1871 to 2022 how futures have performed compared with equities and bonds. And you can see the futures had a disastrous start through the end of the 19th century and the beginning of the 20th century, but then picked up. At various points, they picked up to the point where they were ahead of equities, but they ended up below equities. And so over the long run, we've had a substantial risk premium from futures from 1871 of 4.4%, but that's been less than the risk premium from US equities. All of this is cumulative excess returns. So we're looking here at the US equity risk premium relative to bills and the futures risk premium relative to bills, and the US bonds premium relative to bills, which we sometimes call the maturity premium. So futures did very well, but not quite as well as US equities. Now we want to do the same thing, but we want to compare it for other countries rather than just the United States. And there we only have data from 1900. So the next chart is going to be from 1900 onwards. And here, once we knock out that early disastrous period for commodity futures in the 19th century, you can see that futures actually beat equities in terms of the risk premium, and of course, both handsomely beat bonds. If we look at the world index, the same pattern is true, but the outperformance is even greater. And if we look at Germany, France, Japan, Britain, Switzerland, you can see that in all of these countries, the excess return or the risk premium from futures, when converted into the country's local currency and compared with the local, the excess returns on equities and bonds, you can see that the futures have come out ahead everywhere. So futures beat stocks, which beat bonds in all countries. These are the drawdowns on commodity futures. You don't get a free lunch. You get periods of deep drawdowns, and you get periods of long drawdowns. But so do you from stocks, and all risky assets have this problem, and that is that you can have long periods where you are underwater. So futures experience large and lengthy drawdowns, but so do equities. The most recent began during the global financial crisis and came, ironically, soon after an influential academic paper by Gordon and Rowenhorst documenting the benefits of futures. So Gordon and Rowenhorst brought out this paper. A lot of people went into the commodity markets on the strength of the evidence that they presented, only to find that they had entered a very deep drawdown. This is often the case. And the problem is that then a lot of those investors lost faith, just as the futures would have been really useful to them as we entered the recent period of higher inflation. How do futures perform in different economic scenarios? Well, during recessions, they do poorly. During expansions, they do well, which is exactly what you might expect. And here is how they perform in inflation. What they like is above average inflation. That's when commodities do well. In periods of below average inflation, commodity futures do poorly. And what about stagflation? We're looking here at lower economic growth, higher inflation and lower inflation, and that's the stagflation. They do quite well in periods of stagflation because stagflation is a period of higher inflation. And that's how they do in periods of stable growth, which is not very well. So this is a contrary asset. In fact, it's an asset where the correlations between futures and equities are low and useful, therefore. With bonds are negative, and so they're a hedge for bonds. And with inflation, they are positive, so they're a hedge for inflation. So low correlation with equities, a hedge for bonds, and a hedge against inflation. How do other asset classes compare in terms of correlations with inflation? Well, there's bonds, absolutely terrible. Bonds hate inflation. There's bills, even worse. Here are equities, not as bad as bonds, but still negative. Here is a global 60-40 blend between, as you'd expect, bonds and equities. These are UK inflation-protected bonds because they have the longest history in the world of inflation-protected bonds. If you hold an inflation-protected bond to maturity, it exactly matches inflation. The strategy we're looking at here, though, is holding long inflation-protected bonds and then always holding long inflation-protected bonds. So after a year, you roll it over and you make sure you're still in 20-year inflation-protected bonds, and they do nothing of the sort. They do not then protect you from inflation. Here's real estate, house prices across 11 countries. Here's real estate, commercial real estate, investment real estate, all negative. To get positive correlations, you need to enter the commodity world. Spot commodities, positive correlation, a hedge against inflation. Futures, 0.21, a hedge against inflation. Gold, a hedge against inflation. Inflation has a negative impact on stocks, bonds, and real estate. Commodities are almost unique in providing an inflation hedge. So, just to sum up, financial history can inform future strategy and help us understand the present. A quote from Teddy Roosevelt, the more you know about the past, the better prepared you are for the future. And commodities, a balanced portfolio of futures have provided attractive long-run returns. They've been a hedge against inflation, unlike stocks, bonds, and real estate, but they can have long and protracted drawdowns like all risky assets. Thanks very much. I'm going to hand over for questions.